What is China and Russia's grand strategy to dethrone the US to change the trend of the dollar's dominance? What are the most effective ways to protect your investments in this historical era of international conflict? The US dollar has dominated international trade for decades, giving the US government tremendous power and sway over all nations. Even China cannot escape the dollar's influence in our global economy, but over the past few months, something intriguing has been emerging. Hello guys, welcome back to the channel, and greetings. Today's video will about China and Russia's strategy to dethrone US dollar, so stay focused. The value of the US dollar has soared to its most significant level in years, all while the dollar, euro, yen, and even the renminbi of China have fallen to new lows. According to this Bloomberg story, the strong dollar is causing turmoil worldwide. However, a long-term strategy by China and Russia to weaken the dollar's hegemony and allow other currencies to take its place is about to change something. The US dollar has a 71% market share among the currencies used by Global Reserve in 1999, yet it has decreased to 59 over the last 10 years. And if China and Russia's strategy succeeds, a new global reserve currency could develop within the next 10 years. Understanding this China-Russian plan requires that we must understand: why does the US dollar hold a monopoly position among reserve currencies, and why is it so vital? The US dollar is a currency of trust, thus that is the first justification. Let's imagine that Peru and Nigeria, two completely random countries, desire to trade with each other. However, because of the potential for severe currency fluctuations, both countries prefer to adopt a more stable currency for international transactions. Since the US dollar is less erratic and more durable, both nations can feel more at ease conducting commerce. The money used in roughly 80% of global trade is the US dollar. The second factor most nations favor is that you can only buy oil from Saudi Arabia in US dollars. In exchange for protection from the US, the Kingdom of Saudi Arabia agreed to only trade its most valuable commodity in US dollars in 1945. The SWIFT banking system, developed following World War II and today control all global financial transactions, is the last justification. SWIFT is currently used in more than 200 nations and 11,000 organizations worldwide. Nonetheless, hostilities between Russian escalation between China and the US is happening quickly. The US is under fire from China for its support of Taiwan, while Russia is currently the target of most international sanctions. Due to US sanctions, Russia cannot use its US dollar reserves, and most Russian banks and enterprises have been kicked off the SWIFT network, which restricts their ability to conduct business internationally. The West thinks that by continuing to isolate and sanction Russia, Putin will finally end his conflict with Ukraine. However, Russia has a strategic edge that makes it more difficult for this to happen. Russia is one of the biggest oil and gas producers globally, giving it significant influence over Europe and the rest of the world. Therefore, Putin requires nations to buy rubles to acquire oil and gas from Russia, despite Saudi Arabia and other countries selling their oil in dollars. Thus, even though European nations have banded together and supported Ukraine in this continuing war, many have had to swallow their pride and buy Russian rubles to pay for oil and gas. China also has influence thanks to the Belt and Road Initiative. The BRI project in China costs $3.2 trillion. China provides countries around the world with significant loans. There are already 165 nations around the globe that owe China a total of $385 billion because of the BRI project's dominance in the future growth of our world. Some of these nations are now struggling to repay their debt because they have accumulated too much debt. 42 nations owe China loans that are greater than 10% of their GDP, according to a recent analysis. Now that China has such significant leverage, there is an excellent chance for China to influence the destiny of the world's reserve currency. China might start requesting that these countries take and repay loans in Chinese yuan, instead of US dollars, to persuade more countries to utilize Chinese money when trading. China might offer incentives to nations by reducing their debt by 1% to encourage them to select this course of action. We'll see how this works out in practice. As an illustration, consider Pakistan, which currently owes China more than $24 billion. A 1% reduction of $24 billion for Pakistan would be significant. China has been preparing for this action for a long time. In 2018, the Pakistani central bank approved cross-border business with China. Since then, Myanmar, Cambodia, and Russia have also done the same. The colossal shift in global trade over the past 30 years is the last piece of the puzzle. At the turn of the century, just a small number of nations in Africa and the Middle East ranked China as their top trading partner. Today, most of the globe still depends on China and views it as its largest and most significant trading partner. China may therefore persuade numerous nations to use the renminbi instead of the US dollar by using debt and trade as leverage. The majority of these countries with debts to China are either extremely poor or emerging nations, which is one of the major objections to this proposed strategy. What about Europe's and other American allies' large superpower economies? Is there a danger that China may utilize its clout to compel some of the world's largest and most potent economies to begin operating more Chinese renminbi? Through bilateral currency exchange arrangements, China has an opportunity to succeed. Similar agreements have also been made recently when Indian businesses exchanged US dollars for Asian currencies to buy Russian coal. And this is precisely what a bilateral currency swap agreement is, in case you've never heard of one. Essentially, it is a currency exchange arrangement between two central banks. The central banks then take the swap's proceeds and distribute them to commercial banks operating in their economy, providing the nation and its businesses with short-term access to foreign currency liquidity. You may be wondering what the benefits of these currency exchange agreements are. One of the biggest is that both nations are no longer required to trade in US dollars, which is where things start to get interesting. China's government has inked bilateral currency exchange agreements worth more than 3 trillion yuan with more than 40 nations worldwide, including some of the largest economies in the world. China, South Korea, and Hong Kong have signed a 400 billion yuan apiece currency swap agreement. 350 billion yuan apiece with the European Central Bank and the Bank of England Singapore contributed 300 billion yuan, while Russia contributed an extra 150 billion. Even though 59% of the world's currency reserves are kept in US dollars, China and Russia now have the potential to utilize their leverage to alter the destiny of the world's reserve currencies. China and Russia have been hoarding gold for the past 10 years, another intriguing development that has largely gone unnoticed by most Western media. China has bought almost 112 tons of gold in the last 2 months alone. Additionally, China has increased its purchases of gold from Russia, with imports rising by an unprecedented 750% in July alone. This is a huge issue because there have been suggestions that Beijing and Moscow may eventually connect their current currencies to gold, just as the US did when Richard Nixon devalued the US currency in 1971. In conclusion, it is tough for everyone with money invested in this market as the dollar gains strength. For instance, the S&P 500 dropped 8 points last month after Bloomberg said there is a 98% likelihood that a recession is on the horizon. Practically all equities have been harmed, regardless of how diversified your portfolio was. However, as we wrap off today's video, we wanted to share a new cutting-edge method for diversifying your holdings. Instance, Goldman Sachs just last week issued a surprising study in which it said that the traditional stock and bond strategy wouldn't be sufficient to keep investors afloat. As a result, the graph decreased by more than 20% this year. According to Goldman Sachs, the ideal equity allocation has dropped from 60% to around 45%. They advise investing in tangible assets like art, which could protect your purchasing power and increase in value at an unprecedented pace of 33% per year on average the last time inflation was this high. This will help you salvage your earnings. That's all we have for you today. Take a look at China-Russia's strategy to dethrone US. If you enjoyed this video, give it a thumbs up. If you don't want to miss any future videos, subscribe to the channel and switch on notifications. Please participate and share your thoughts in the comments section below. Thank you so much for watching.